Good day, dear colleagues. As always, the ForexTimes project, as always, is in full swing. Despite the rain, I'm in a good mood today, and as always, we will discuss the potential movements of trading instruments for the upcoming trading week. Dear colleagues, please join the ForexTimes community. We'll earn money together and explore interesting materials. And believe me, I'll open up a new universe for you, especially in terms of effective capital management. I recently gave a lecture to two individuals this week, and it turned out they had never heard or encountered such concepts in their lives. They were very impressed, so please come and join us. Today, we will begin by looking at the possible trading instruments, starting with the SP 500 index and the Dow Jones index. By the way, during my lecture in the community today, we identified 5 trading instruments with the highest probability for profitable entry in the upcoming trading week. 2 of them, which we will discuss today, are the euro and gold. Why do I start with the SP 500 and Dow Jones indices? For a simple reason. It's more likely that both of these trading instruments will continue to decline. Entering the market with the S&P 500 index can be considered after a certain correction, let's say around 50%, according to Fibonacci retracement from the last drop, followed by further decline. However, regarding the Dow Jones index, it's better not to enter the market for selling even after a corrective upward movement. The reason for this is that this wave strongly resembles a zigzag 3 ABC pattern, not an impulse wave. If we have a zigzag 3 ABC pattern, unfortunately, we can't talk about an impulsive decline for the Dow Jones index. Now, about selling, there are 2 key points. The first point is, the largest accumulation of put option contracts by professional participants like commodity exchange hedgers. At this moment, these purchases represent the highest accumulation over the last 3 years. The likely formation is nothing other than a head and shoulders pattern, actually, a double top in the form of a shoulder, then a head and a double top in the form of a second shoulder, with the neckline being broken. Any return to the neckline level essentially opens the possibility for a market entry for selling. However, these 2 trading instruments don't hold much interest for the upcoming trading week. Instead, we will focus in more detail on the euro and gold. So let's go. The euro for the upcoming trading week, it will be very profitable to consider buying, but buying is not easy. What do you have there? The trading storm has opened. Hooray, grab the gun and start buying euros. No breakthrough under no circumstances. Dear colleagues, we work exclusively based on market entry patterns. And the first thing I want to say here is why it is most likely to consider buying the trading instrument is the wave structure of the market. Let's assume we have this impulsive movement, then we have a flat ABCW, then ABCX, and now we are in wave Y, which will be, of course, a rise. The simple reason is that the flat is a correction formation. Let's say I'm wrong, and in that case, we have an impulsive movement. But in such a case, the flat is even simpler. A, B, and 5 wave structure, entirely C, and again, likely to continue to rise. Maybe I'm wrong tenfold, and in this case, we have an impulse. Then here we have waves 1, 2, 3, 4, 5, and then a correction in wave B, followed by a further continuation. But for the upcoming trading week, we can see that I keep drawing the second wave all the time. Here, precisely, it's an increase. So we'll consider it. First of all, if we look at the monthly option contracts, we will see that the price is already in the strongest support ranging. These are hedgers with their premium levels. You know what hedging is? It's the maximum open interest by speculative contracts that professionals are hedging. Therefore, there's already strong support for the euro. What's interesting is that we have a pin bar. Indeed, it's a liquidity event. At the moment, the price has not moved far below the pin bar. There is a high likelihood of growth. What concerns me about monthly auction contracts is the accumulation of option contracts here, approximately for $1 billion, which is quite a lot. And it's about 80 pips away from the current price. And what's even more interesting, dear colleagues, if we jump to weekly option contracts and look at the reports from the Commodity Futures Trading Commission, we will see a 16% decrease in buyers and a decrease in capitalization, meaning buyers have left the market taking their money with them. However, it should be noted that the trend remains upward. At the moment, there is nothing but a corrective downward movement, as you can clearly see. A corrective downward movement over the last 2 to 3 weeks, moving in threes, and they move in threes for a simple reason. We can try to roughly say it's a terminal diagonal. We can try to stretch it not so gently. From earlier positions, you just need to sit down now and read all the waves, because the diagonal can be stretched in such a way. So you just need to sit down, count the waves, which one fits here, and try to use it as a starting point. But if we also look at weekly option contracts, the same as we saw with the monthly ones, we will see that the price is very close to the strongest support range. Here we have the market maker's loss level, which determines the market maker's zero income, i.e., organizations providing liquidity for auction contracts. Everything below at the time of expiration on Friday evening will be borne by the market maker as losses. Therefore, this level and this level will change every day, but not significantly. They will try to protect it and try to buy euros. For us, the target level is clearly this accumulation of option contracts at 82 million contract points, call option contracts right at the level of option contracts. In addition to the maximum open interest in call contracts, there's also a significant amount of private investors, $82 million. And now let's take a look at the Chicago Mercantile Exchange, euro dollar specifically, and let's look at weekly option contracts with an expiration date of September 29th. We can see these call contracts I just talked about. Here on 2 strikes, there is a huge open interest volume. On strike 1.065 and on strike 1.06, there is an enormous open interest volume in point contracts. Where is it? Actually, I'll remove it now. Actually, where is it? Here, this entire volume is located. And what is this volume? It's volume. The path of option contracts through which they hedge their futures contracts for buying. So, if there is a massive volume of option contracts here, believe me, there will be 4 to 5 times more futures contracts here. For example, if there are 1 billion or maybe 300 to 500 million, multiply by 5, and you'll roughly get the sum of futures contracts that professionals will enter the market with. Therefore, any drop in the euro suggests that we need to consider buying. Any pattern for buying is under consideration. Of course, as always, I hope that on Monday, Tuesday, and in the first half of Wednesday, but the euro will drop and reach its minimum value here. We have a beautiful final diagonal forming here, and a pattern, either an impulse or correction, can be bought, or a pin bar pattern with liquidity exhaustion. And by Wednesday, in the second half of the day, I will enter the market to buy. Colleagues may have noticed that I often talk about the second half of Wednesday for some reason. I just often say that it's desirable for the price to come down here on Monday, Tuesday, or in the first half of Wednesday, and then we will do reversal trades, dear colleagues. The reason for this is that Wednesday is a banking day. I won't explain the whole theory of banking days right now. You can find this information mainly on the Eurocent Bank's website. Please take a look at the theory of banking days. I think you will find it very interesting. Well, or you can simply open any trading instrument and see what happens specifically on Wednesday. For example, if we take the euro in the past few weeks, let's see what happened. Well, for example, this was a Wednesday. This was a Wednesday. What else do we have here? Well, this is Thursday, probably. So I assume that this was a Wednesday. Here was a Wednesday. Here was a Wednesday. So actually, you can open any trading instrument and read about the theory of banking days. I assure you that you will find it very interesting. Well, now let's talk about gold. And gold here is even more interesting from the perspective of correlation. If we assume buying the euro after some downward movement, then gold is expected to be purchased after renewing this minimum. Dear colleagues, as much as I may not want to sell gold, the simple reason is that, you know, I really like the construction, 1, 2, 3 WX. I wanted to see 1, 2, 3 Y so that we know what to do for the whole year. We could buy gold. In theory, we should be buying gold already. However, the problem is that in the hypothetical wave Y, gold forms a triangle. As you can see, each maximum value is lower than the previous one, and each minimum is higher. Unfortunately, it's in a triangle. Why do I say unfortunately? Dear colleagues, it's because this triangle can be worked out in both directions. If we want to buy, we can just create a construction like this, WX, A, B, C, D, E, and draw the triangle. If we assume working it upwards, it can be done like this. If we expect it to go down, we have W, and then a triangle can be represented like this, A, B, C, D, E. There's also a pin bar formed here, but without liquidity, I don't think the decrease will be significant. However, if such a combination can be represented in wave X, then a decrease in wave Y is quite possible. But considering the reports from the Commodity Futures Trading Commission about an 8% increase in buyers and a 3% increase in capitalization, it suggests a probable upward movement. In principle, this upward movement can be conducted through the triangle as follows: W, X, 1, 2, 3. The penultimate triangle is our penultimate wave. Therefore, it can be WX, and then the triangle A, B, C, D, E. I'm showing it going down again. I apologize, colleagues. I'm getting tired by the evening. I've already read a long lecture today. Now let's look at hedgers of options. Here, the level of loss is significantly higher than the euro I mentioned. It's right below the price. Oh, the options collar is quite high at a strike of 2,000. But here, the strike of 2,000, let's look at the data from the Chicago Mercantile Exchange. we can see that gold is already within the support range. Options contracts with a weekly expiration on September 29th are slightly above the price. This means that the price is already within the support range. The options contracts are 1.5 times larger in volume than the contracts at a strike of 2,000. This tells us that professional participants in the Chicago Mercantile Exchange are waiting for nothing but this trading instrument. But dear colleagues, we need to be very careful here. The reason is that we trade impulses and corrections. Impulse, correction, impulse, correction. We either trade the third wave or the fifth wave after the fourth. The fifth wave is quite rare. We never trade or catch waves 2 and 4, wave B, wave A. So what I'm saying all this for, I'm saying all this for the fact that we have a 3-wave obvious structure. And I'm talking about buying, you know? So it's not an impulse, by no means an impulse. And by the way, dear colleagues, I just saw on the market we have movement that can probably be 1, 2, 3, 4, 5, and thus form a little triangle wave A, B, C, D, E. And after that, the trading instrument, well, I apologize, I'm just getting tired. So on the daily time frame, for some reason, I didn't see this probable impulse combination right away, actually. A big wave A, big B, and already moving into the wave for buying. So the thing is, dear colleagues, here, there's no impulse. Here it's a 3-wave structure, 1, 2, 3. And a 3-wave structure cannot be an impulse or the start of an impulse except for the initial diagonal, you know, like an initial diagonal. But the thing is, in the initial diagonal, nothing seems to match yet. So I assume that we will still renew the minimum value, and I will hope for it very much. Specifically on Monday, Tuesday, and the beginning of Wednesday, that we will renew the minimum value and will enter the market for buying based on the pattern. I apologize, dear colleagues, for this long lecture today. I just wanted to explain everything fully. By the way, from the perspective of correlation, for gold, for the euro, everything aligns. Renewing the minimum value and entering the market based on the pattern for the euro for buying, the same for gold. Well, thank you, dear colleagues. I apologize for today's lengthy lecture, but I wanted to cover everything as thoroughly as possible and show everyone a great upcoming trading week. Have a good evening, everyone. Goodbye.